Hello, welcome to Any Unanswered for April 2019. As ever, Tim and I have chosen two questions to have a look at, hopefully useful answers. One is a topic we're very happy to talk about because it's CPD. TP Ames has asked the question, where an employee personally incurs CPD costs which are not paid for or reimbursed by their employer, are those costs an allowable expense where they have to incur the costs under their contract? Well, we're into the whole wholly exclusive necessarily and all that sort of thing, aren't we?
Yes, I guess. Section 336 ITPA, Income Tax Earnings and Pensions Act, and the first respondent to this query, R. Weaver, says under 336 to be allowable, the employee must be obliged to incur the cost and pay it as holder of the employment. Additionally, the amount must be incurred wholly, exclusively and necessarily in the performance of the duties of the employment. I'd agree with all of that. CPD costs are not incurred in the performance of the duties. They put the employee in a position to undertake the employment duties. As such, they are not allowable. Now, as far as it goes, I would agree entirely with the answer put forward by R. Weaver. However, Stilacker then says if CPD is contractually a part of the duties, the cost may be allowable. To which I would agree. R. Weaver comes back with a case, the DCAT case, but was it Dr. Banerjee? Who was training to be a consultant dermatologist. And I remember in one of my lectures describing her as training to be a consultant ornithologist, but I got my words in a muddle. Anyway, she was under a contract with an NHS trust, a training contract that required her, as part of her duties, to undergo the necessary training to progress from registrar to consultant. But the NHS Trust couldn't fund it. So she met the cost herself, and she then, eventually in the High Court, succeeded in establishing that those costs were deductible. Now, that was the exception that proves the rule. Generally, if an employer of a firm of accountants came to one of our lectures as part of their CPD, but their firm didn't agree to pay for it, no, you wouldn't get relief. So I would agree with that basic point. Okay. A couple of further things. Last year, the government and the Revenue announced a consultation on allowing that work-related training, where the cost is incurred by the individual personally, whether an employee or self-employed, should be allowed. But they dropped that in the autumn. It was announced that they were not going to go ahead with that. So there has been no relaxation of the rule. And it does mean that there's a lack of symmetry between the legislation applying to a self-funded employee and that applying to the employee whose employer meets the cost. Because if the employer meets the cost, it is tax deductible for the employer, but a tax exempt benefit for the employee, work-related training being specifically exempt. So that seems a bit unfair, but life is unfair, let's get over it. Now, a further point was then brought up by DJKL. There's possibly scope for salary sacrifice with the existing arrangement. Do you think that would work?
I think you're into optional remuneration arrangements.
Optional remuneration arrangements. What would we do there if there were a salary sacrifice and the employer were to say, well, what we will do is meet the cost of these courses, but if you agree to reduce your gross pay by $1,000 a year, well, we would then have to determine the benefit on the hire of the exempt amount of nothing or the amount of salary foregone. So I don't think salary sacrifice would work.
No, but it does demonstrate that. I mean, when the suggested new legislation was published by the Treasury, it would have opened up a huge amount of opportunity and potential. But I think it was the cost in the end that made them realise they couldn't really afford to do it because so many people would have benefited from it. The second question is from Aidan Joseph, who has asked the following question. My client and his wife own a second property and she receives the rent. Their son is also on the deeds, so a third each, I guess, ownership. The son is now buying a flat and does not want to pay additional stamp duty, so he is being removed from the second property deeds. The property has increased from $285,000 to $380,000. Will the son have capital gains tax to deal with? Well, I have a question before we start on that. Is that going to work in terms of the stamp duty point, do you think? I guess logically it probably does. He's getting out before he buys his own property.
Oh yes, I mean the SDLT point is what's driving this, and Osborne introduced the additional 3% penalty, if you like, for SDLT if the purchaser of residential property on the date of completion of the purchase has on that day an interest in other residential property. And so if the son retains an interest in the property that we're talking about, that is jointly owned apparently with his parents, then the acquisition of his own residence will trigger that additional 3%. So the fundamental premise of the question is absolutely valid. The various respondents sought to tie down the facts and the details, quite right too, because you need to find out what's going on here. It turned out that the property in question had been inherited on the death of the grandmother. So we've got mum, dad and son, and it was death of mum's mum, the grandmother, that resulted in the property now being owned by the mother, father and son. Aidan Joseph says the property was in fact owned by dad and mother as tenants in common. When she died, the dad added his wife and son to the deeds. Now, you know, that's slightly unclear still, but presumably in slightly more legal terms, what happened, and it seems to me now rereading that it's unclear whose mother died, but anyway, what happened was that the property was inherited by husband and wife, and they inherited it as tenants in common and then conveyed a 1/3 share to their son. So it's now husband, wife and their son as tenants in common with 1/3 each. Well, yes, you've got to have the son get rid of his 1/3 interest in order to avoid the 3%. How does he do that? Well, if he simply gives that up in favour of his parents, that would indeed be a chargeable disposal for capital gains tax, which was the basic point of the question. But behind it, there are all sorts of other issues, because we're told that the rental income was from this rental property was entirely on the mother's tax return, and that at the end of the correspondence, the original questioner says they prepared a declaration of trust so that the wife, the mother, received the rent. So we had the property owned as tenants in common, 1/3 share each by husband, wife and their son, but a separate declaration of trust to the effect that, well, to the effect that what? Because that declaration of trust is only going to be valid if it declares that the beneficial interests in the property itself are 100% the wife, and then all of the rent goes to the wife.
Which would then mean for capital gains tax as well?
For capital gains tax, it's then the wife's and not the same. So it's very unclear at the end, and it just highlights the need for families in this situation to get proper legal advice. And I do wonder what that declaration of trust was all about, because that doesn't sound right at the end of it.
Because the key point is that if he does own 1/3 and he legally and beneficially owns 1/3, then yes, it's a chargeable gain, and therefore we would have to deal with the capital gains tax consequences. But potentially, because of the way it's been structured, he might not have been involved for CGT in the first place. And as Tim says, does demonstrate the need to make sure that all of the professionals involved know exactly what they're talking about in this sort of situation. Otherwise, we can end up with entirely the wrong person paying tax on something that they didn't beneficially own. Hopefully useful. Any questions you want to put, feel free to add them to the Any Answer section of accountingWEB, and perhaps next month it'll be your question that we're having a look at. But for this month, bye-bye.